All right, it's 11 o'clock. Thank you guys so much for hopping on. I'm Jason Engelman, CEO of Freaky Fast Home Buyers and Investments. And we've been doing these webinars bi-weekly. We're probably going to get it to where we're doing it eventually weekly. The few webinars that we've done, we've talked a lot about the real estate market, what to expect, where is it going, how to invest in it, how to be successful in it, how to win in this type of environment. It's interesting. I talk to investors every day, all walks of life, different backgrounds, different uh, stories on how they created their success, different strategies on what they like to invest in. And it's interesting. You can ask, and of all ages too, people who've been around for many, many decades, seeing the changes and the shifts, the ups and the downs, the booms and the busts. And it's interesting just kind of getting their perspective. And then also talking to some of the younger investors who maybe are fairly new. So they don't really remember what it was like 2008, 2009, 2010. I mean, they were alive, obviously, but they weren't necessarily actively investing. So they weren't really affected by the market collapse or the recession that took place. And so it's just kind of interesting to talk with each individual and kind of get feedback on where their mind is. So many people are so easily influenced, whether it's based off of a news, a TV station, or a podcast, or an article in the newspaper that they read, or a book, or maybe they go to some conference. It's just amazing how our emotions can fluctuate. They can go up and they can go down. It's that proverbial emotional roller coaster that we always hear about, but it's so true. And I think a lot of times too, these news stations or these conferences or these Facebook ads, they play off those emotions, and they are able to sometimes dictate even the market based off emotions. We've seen that happen all the time. So how can we be successful in this type of environment? Well, the one thing that I'm doing right now is I'm praying for wisdom and discernment. I think that's so important. Having wisdom and being able to make my own choices and have discernment to say, okay, I'm hearing this report, but I'm also seeing this data. I'm seeing these numbers, and they don't really align. Why is that? So sometimes it's trying to figure out how can they align and how to make the right decision. If I see maybe something coming up a few months down the road and how it may affect selling a house or buying a house, I'm going to have to make certain decisions, pivots, audibles to make the right call and make sure we put ourselves in a position to succeed. So yeah, that's where we're at right now with this real estate market. A lot of people scratching their heads. A lot of people thought a recession was already going to hit, and to the chagrin of a lot of experts, prices really haven't changed. They dipped a little bit last year in the fourth quarter, and were affected through the middle of the second quarter of this year. And then all of a sudden you started seeing prices going back up. The reason for that is just because of the lack of inventory on the market. So many people are still looking to buy homes. We're in one of the largest migrations in the history of our country because of the millennial generation looking to buy their first home. And so you're seeing this huge demand, even with interest prices going up, and people having a hard time finding a deal. Another reason you're seeing these prices stay the same, 9 out of 10 people who've got mortgages right now have interest rates less than 5%. So even though they may have a lot of equity in their home, they're not necessarily jumping up and down to sell their home because they're going to replace their really low mortgage with a higher mortgage because of the interest rates. And they're afraid if they do sell their home, they may not be able to find another property that suits them or what they're looking for. And so it's causing them maybe a little bit of to go into more of a holding pattern and wait and see type of thing, which is again keeping inventory down. Another reason why inventory is down is because of the lack of new construction. 2008, 2009, 2010, new construction came to a halt. So many of those companies went bankrupt and lost lots of money. And so they've tried to learn from that. So in So from there, production slowed down, which put us in a deficit. But then when 2020 hit and COVID and lockdowns and quarantine, people were afraid that 2009, 2010 was going to happen again. So they slowed down production. Plus, there was a lot of backlog with materials and so forth that also slowed down production. So we're at a major deficit. We could increase our new construction builds 2-3 times and still take a couple of years to get to where we need to be. So if you factor all those in, you've seen prices stay somewhat stabilized, and in some cases even gone up, even with high interest rates. So how does that affect us today? You know, again, we're seeing foreclosures going up. We're seeing credit card debt going up. We're seeing a lot of signs that are making a lot of investors go on pause, thinking, okay, what's going on with the market? But yet we're also still seeing the prices stay very, very good. We're still seeing properties move. So we're kind of in uncharted waters. Again, I think that's why wisdom and discernment is going to be so key. So what we're going to be talking about today, last webinar, we mentioned how you can start investing in single family homes. And we mentioned 3 different strategies, and we're going to talk about one of those strategies and how you can really capitalize on these type of opportunities, and then also share with you guys our special promotion that we're offering right now in the month of October. So let me just tell you a little bit about Freaky Fast. If you're not familiar with our company, I started the company in June of 2019. We purchased our first 3 homes in Columbus, Georgia, about an hour and a half south of Atlanta. What makes Columbus famous is Fort Benning, one of the largest military bases in the country. It's an American institution, and a lot of the Army and like the Rangers, Special Forces do a lot of training there. And so that's one of the main staples of Columbus. Started investing there before it really became super popular. A lot of people are still targeting some of the bigger cities like Nashville and Dallas and Boise, Idaho. And so we went into the secondary market, and it taught us that there's other opportunities out there. You don't necessarily have to go to the hottest markets in the country and fight all the competition. So we started working with investors, and we'll dive into this a little bit more, but they started doing what we call private lending, which is the topic of today. And through that, and with our investors, we were able to grow into 5 states with over 30 million assets under management, again, primarily through private lending. And what it created was an opportunity for us to grow, but also for investors to have really, really good investments. Now, where we're trying to go in the next 12 months is to 100 million under management. So we're looking to add to our investment horsepower, and we are looking to create opportunities to take advantage of where the market is and where the market's going, both for ourselves, but also for our investors. And so I'm super excited about today. If you are on and you're watching, we've got a few attendees that we appreciate you hopping on. Please message us in the chat box. Let us know where you're watching from. If you've got any questions, please put those in. Alex, who is one of our investor advisors, is on this, and he'll be glad to talk with you and answer any questions. And you can even schedule a call with him and learn more about us and our promotion. I'm going to share our screen, and private lending. So for some of you, maybe this is something you've done before. And for some of you, maybe this is something completely new, something different. And that's okay. We'll hop in and just kind of show you how you can get into the real estate investment game from a different strategy than buying houses. And that is private lending. And so we're just going to hop right in. There's 3 ways to invest. We mentioned this on our last webinar. There's private lending, there's long-term rentals, and then there's short-term rentals. Those are the 3 primary ways to invest in single-family homes. Now, there's a lot of variables. There's a lot of different strategies. Note buying versus just being the private lender on the very beginning. There's different strategies in long-term rentals. You know, maybe it's student housing, or maybe it's corporate housing. Short-term rentals, it could be, you know, traveling nurses. It could be Airbnbs, VRBOs, and so forth. So there's a lot of different variables and different options out of these three categories. We're going to be talking about private lending today. What makes private lending effective? It's effective both for the borrower and the lender. Now, you may say, what is private lending? I'm not really familiar with this. Most of you, though, probably have purchased a house at one point and you got a mortgage, whether it was with Chase Bank or maybe a specific mortgage company. Or maybe you hired a broker who outsourced your application and your loan and your deal, and then you had multiple mortgage companies reach out to you and offer you terms, and then you were able to select which one made the most sense. Well, those are what we call lenders. They're lending you the capital to purchase the property. What's exciting, though, is there are opportunities for you, the investor, to step in that role and be the bank, so to speak, or the lender for other people looking to buy homes. Now, what's exciting about that is there are a lot of strategies and ways to increase your wealth and build up your wealth by doing private lending. I'm going to just kind of break down on how this can be effective both for the borrower and for the lender. So I'm going to start first with the borrower and explain to you why this is so helpful to people like us who are in the game, who are buying homes that are looking to buy. Because at the end of the day, without the borrower and the need for a lender, there's not an opportunity to lend. So let me explain to you why there's a need and why this is a great opportunity for you. As a borrower, there's three advantages to borrowing money from a private investor. One is speed, two is flexibility, and three is relationship building. Speed, let me explain to you. Sometimes you're looking at buying a house and you've got multiple offers coming in. Obviously, we buy houses at a discounted price. We're buying houses anywhere between 40 and 60 cents on the dollar. And there's competition. There's other groups out there who are looking to buy that same house. And a lot of times, though, they're going through maybe a more traditional hard money lender. So it's still not a bank, but it's a hard money lender. And they still got to kind of jump through the hoops like they would with a bank. With a private lender, we could speed up the process to within 72 hours or less even. I've literally had deals where I've called an investor and said, hey, I just had a deal come up. I need to close today. Are you interested? Here's the terms. And they wired the funds to me within an hour. And we were able to swoop in and make a good deal. So speed is a super huge advantage, both for both the borrower and the lender, but also because it allows us to maybe get the deal a little bit quicker than anybody else. So if I say, hey, I can buy this house and maybe I offer $10,000 less than Joe next to me, but I can close 20 or 30 days sooner than him, then I may go ahead and win that if you want to call bidding war, because of the speed. A lot of people that we're buying from are in some type of distressed circumstance. Maybe they've taken a job in another state and they got to get out. Maybe they're facing foreclosure. Maybe they are experiencing a job loss, or they've got to move, or maybe there's a sickness or a divorce. Whatever the case may be, they need to sell quickly. In some cases, maybe the house is really deteriorated and in really bad shape. Then they need to get out and they can't take care of it anymore. Or maybe a loved one inherited a property from a deceased family member, and they don't have the time to deal with it, and they just need to get it off the plate. There's usually a reason that they're trying to sell, and speed will help with that. And that's why working with a private lender is such a great advantage to have in your pocket. The second reason is flexibility. And I'll explain a little bit more when I show you how to evaluate deals. But for example, I couldn't necessarily go to, say, like a Chase Bank and get a loan on the property that I am trying to buy. The reason for that is because they only will loan based off the purchase price, not the value of the home. So if I'm buying a home that I know has a higher value, but for whatever reason I'm getting at a discounted price, the bank is only going to loan based off of that purchase price. Whereas a private lender is going to loan based off of the value of that house, which gives me more flexibility to close on that property and be able to add a lot of value to that property. So as an investor, the speed is important, but also the flexibility. Next is relationship building. And to me, this is so key. Nowadays, back in the olden days, you could develop a relationship with your bank. And you can go in, you did handshake type of deals. Bankers were willing to work with you. Your reputation, your name, your word, past history really would go a long way. Nowadays, that's very, very rare. In some circumstances, it's still the case, but usually it's a smaller bank. It's not the Wells Fargos or the Banks of America or the Chases of the world. It's usually like your local credit union or a smaller bank in a smaller town. And so that relationship is just not as powerful. However, in private lending, it is. If you've created a relationship with investors or with someone like me who is a borrower, it's a lot easier to get deals done and in a quickly manner and time because of previous experiences. So for a borrower, speed, flexibility, and relationship building are three huge advantages of private lending. Now, how about you, the investor? Let me show you how it's effective for you. As a lender, you have an opportunity to invest low risk, high ROI, and it's alternative investments. Now, for some of you, maybe like low risk, like how is this low risk? I've never heard of this, or it sounds kind of risky to me compared to the stock market or compared to Wall Street or bonds or CDs or even high interest rate savings accounts. Like, how is this low risk? Well, the reason it's low risk because it's attached to a property and it's secured by that property, and that property's values are not as fluid as what maybe the stock market is. So like I mentioned, as we were waiting for the webinar to start and we had some people hop on kind of early, I had an investor who lost 20 grand last week in the stock market. The market was down and he lost 20 grand. Now it'll eventually come back up, but how long? When? And the thing is, they don't cash flow. So really, you're just hoping that it continues to go up. So once it goes up a certain price and you feel comfortable with that profit, you sell it, and then you make your profit from that. But with private lending, it's a lot lower risk. It's not as fluid, but it also creates cash flow for the investor, which is why a high ROI is on here. Cash flow is so important. You can make a loan and you can get monthly payments. Some investors prefer one lump sum at the end, but most investors like that monthly mortgage payment or that interest payment made to them so they can see that cash flow coming in, and it creates a high ROI. And most of us know the higher the ROI, usually the riskier the investment. So it's very rare that you can get a low risk investment and still create a high ROI. The third reason is it's considered an alternative investment. You don't have to rely on your stockbroker, your day trader who's managing your accounts. You don't necessarily have to rely on Wall Street and the Feds and all these different parties that dictate and create the variables within the market, the ups and the downs. And yet it's something that creates an alternative investment. What's exciting about this too is it creates a way to invest in multiple ways alternatively. You may have cash and you can lend the cash. You may have money sitting in an IRA or a Roth or a 401k and it's just sitting there, or it's losing money because you have it in the stocks and it's just not doing well for you. You can lend that money. Another strategy is you can use your insurance policies. You can use HELOCs. I had a lot of investors when HELOCs they were able to get them at 3-4% interest. Go ahead and borrowing that money and then lending it to me and getting that arbitrage. There's ways to do wraps and wrap around different investors, and you can bring money together and take advantage of increasing and building your IRAs and your 401ks at a rapid rate because of these high returns. So many creative ways to lend and be a private lender, and this is the advantages of being that lender. And we can dive into this a little more We can, if you have any questions, please feel free to ask, and I will get into that. Here's how private lending works. The lenders and the borrowers need each other. For us right now, we're struggling finding capital. The reason we're struggling finding capital is because we've got so many deals right now, and we just don't have enough capital to close. One of the reasons for that is a lot of investors, like I mentioned earlier, were using HELOCs to lend capital to us. And when interest rates went up 9, 10%, they stopped lending that capital just because there wasn't a whole lot to make from. And it was a little bit more risky being that they were borrowing the money. And so a lot of those investors had to pull that capital aside. A lot of investors are afraid right now. They don't know where the market's going. They're concerned and scared about buying a home or investing at the moment because they just don't know where it's going. And so they're kind of sitting on the sidelines, just kind of waiting to see. The problem with that, though, is there's a lot of great deals that we're trying to close at this very moment, and they're missing out on it. And so we're finding ourselves in this really unique situation where we've got more deals than we can handle, and we need lenders. But as well as we need the lenders, there's investors like you who've got liquidity right now. They got money sitting in their banks. They got money sitting in maybe in some type of stocks or day trading that's not doing so hot for them. And they can liquidate and they can take that money and put it in something a little bit less risky and make even probably a better return than what they're making now. If you got money right now making less than 8%, this is a deal that you need to look at. If you got money sitting right now in your bank, you're losing right now. Why? Because inflation is continuing to go up and the value of that dollar is decreasing. So somehow, some way, you've got to take those dollars and make babies with them. You got to get those dollars, mama and papa dollars, making baby dollars. And when you do that through cash flow, you've heard guru after guru, real estate expert after real estate expert talk about how cash flow is king. Well, this is a way to create cash flow. And so the lender needs people like us who have the ability to find deals. One of the reasons why lenders don't necessarily buy is because they struggle finding the deal. So if we are able to work with each other, throw each other bones, we can create a win-win situation. So let me just give you some of the basics of private lending. There's two different types of loans. There's a secured loan and an unsecured loan. Sometimes unsecured loans are maybe paying a little bit more aggressive interest rates because it is a little bit more risky because it's not secured to an asset. Secured loans are loans that are secured by a property. So that property gives you security through a lien position. So for example, if you were to borrow money from Chase, they're going to put a lien on your property that secures their investment. And on a private lending deal, you have the ability to secure a lien through a deed of trust or a mortgage, just depending on the state. And that deed of trust mortgage will secure your investment to that property. Promissory note is what lays out the terms of your investment. So for example, 12% interest, 2 origination points for 6 months, or for 12 months, or for 2 years, or maybe it's, a 30-year note at, 7-8% interest. And, maybe there's a balloon in 10 years. All those details are going to be in the promissory note. So you're going to receive 2 documents if you get a secured loan. You're going to receive a deed of trust or mortgage and a promissory note. On an unsecured note, unsecured loan, you're just going to receive a promissory note laying out the details of the property. I'm going to stop right there for just a moment before we get into the next slide, see if there's any questions. I'm kind of breezing through this, and so I don't want to miss out on any questions. So if you got a question, please feel free to put it in the chat box. We'd love to know where you're watching from and listening from. Got a great showing today. Got 23 attendees right now. So thank you so much for hopping on. If you hopped on just a little bit later, I'm Jason Engelman, CEO of Freaky Fast Home Buyers and Investments. We specialize in single family rental properties. And we started off with 3 properties in 2019, and now we have done over 30 million in assets, and most of that through private lending, through investors like yourself. And so I do appreciate you hopping on and learning how you can take advantage of this. If you have a question, please feel free to just put it in the question and answer or in the chat box. See a couple people raising hands. Just by all means, go ahead and just throw that in the chat box. Great question from Christina. I know Alex responded, but for some of you who may have not seen it, can one of these be tax-free with real estate? And the answer is yes. The way you do that is by investing in a IRA account that is tax-free. So like a Roth IRA, for example. You have a Roth IRA, and any money that comes into that Roth, any profits or increase, is tax-free. So there's 2 ways to get a Roth. One, if you make less than a certain percentage in a year, then you have the ability to open that Roth. Now, the problem with that is you can usually only put, I believe, 6. I think they just increased it to 7,000 a year in your Roth. So it can be somewhat of a slow burn, but it's great for investing like this because then you can start building that up quickly. The other way you can get money into your Roth is what we call a backdoor conversion. Basically, you have money maybe in a 401k with your company, or you have money in a traditional. You can do a backdoor conversion, go ahead and put it into the Roth. Problem is you're going to take a tax. You're going to pay a penalty on that and on your taxes. I usually recommend telling people to go ahead and do it. So you go ahead and take that hit in the beginning, but then any of that money that is now in there that is made is all tax-free. So you do take the hit one time, but then after that, it's tax-free. Now there's ways to offset that tax hit. If you show a loss on a K1 for passive income, then you have a way of offsetting that. So there are ways to create tax-free opportunities through private lending, but they definitely go through the Roth. Also, just to go ahead and throw it out there, if you do private lending, you receive a 1099 at the end of the year showing the profits that you receive. So just for what that's worth, you'll have a 1099 that you're able to give to your CPA. If you have any questions, feel free to put them in the chat box and we'll be glad to answer those. I see a couple people raising their hands. If you don't mind, just go ahead and put that question that you have in either the chat box or the question and answer. Okay, I'll go back to our next slide. How to evaluate the deal. So you say, okay, I am in. This sounds like something that I'm interested in. I've got money right now. How do I invest? How do I get started, or what do I even look at? Okay, so there's 3 things that are very important. Number 1 is the ARV. Number 2 is the loan to value. And then 3, comps. And you're able to figure out the ARV and the LTV by the comps. ARV means after repair value. Now, as private lenders, most private lenders will lend based off of what the house is worth once the rehab is done versus the purchase price of the home. And that's why private lending is so effective, like I mentioned earlier. You know, if you were to go to a bank, they're only going to loan the capital to you based off the purchase price. Whereas lenders will lend based off of the after repair value. So a lot of times we're able to buy homes that we know is going to take around $40,000 to rehab. And we are going to be able to sell that house after that $40,000 has been put in for, say, $175,000. So we're able to buy that house maybe at $80,000 or $90,000. Put the 40 into it, be all in around 130, and then have a nice little equity. Private lender is going to be able to lend that capital based off of the ARV, and A lot of times lenders, depending on the deal, depending on if it's a little bit more in-depth rehab, or maybe it's a little bit like just come in, paint it, very cosmetic, very quick, will determine how much they're willing to lend on that ARV. Some investors like 65% loan to value. Some people like 70% or 75%. And some are open to lending even as high as 80% of the loan to value. Private lenders will lend the acquisition and the rehab cost as long as it fits in that loan to value. The way that you are able to figure all those numbers out is based off of comps. One thing that we provide to our investors is comps on our properties to show them how we determined the ARV of the home and the loan to value. Let me give you an example of what that looks like. This is a property that we purchased in Germantown, Ohio, just, I don't know, 20 minutes outside of Cincinnati. And we purchased this property for $95,000 back in September 2021. And we purchased this property at a discounted price because the owner of the home had issues with tenants. And it was still kind of during that time where it was hard to get tenants out, and they could kind of stall the process and courts were backed up. So we got this deal at a discounted price because of that situation. And it took us forever to get them out. So we actually didn't start rehabbing this property until I think it was like February or March of 2022. And then we put it on the market for I think around July for $220. So we purchased it for 95. We put 40 in. And so we were all in around 122,000. And we put it on the market for 220. And it was right in that time where interest rates started jumping. And before then, you were getting multiple offers, and you were getting offers way over asking. We actually got an offer for $199, and at the time, I wish I would have taken it. There were some different things that they wanted discounted on, that they wanted a credit for, and then they would do it. They wanted a new roof. We didn't feel like it needed a new roof. They wanted a couple things done with insulation and so forth. So it was more of a desired want versus a necessity. And so we told them we would put it in, but they wanted to do it themselves with their own contractors. And so they wanted a $30,000 decrease. And for us as an investor, I know we could have done that for 15. So I said, no, we'll do it ourselves, or we'll just walk away from the deal. Well, we walked away from the deal, and that property started to sit and sit and sit. We weren't getting showings, we weren't getting offers because of the interest rates in the third quarter going up. So I pivoted and I put this property in our rental portfolio. We leased it out, got $1,400 a month. So we were making, a really good return based off the cash that we had in on the deal. Well, back just a few months ago, the lease was coming up. And I was like, you know what? I'm going to see what our property is worth based off of what the market is doing now. Prices were really starting to change. Prices were going back up. The market was getting hot again. And so I pulled up the comps for this house. And I just kind of want to walk you through it for a minute. So here are 4 properties that all sold this year. And at the time when I had put this together, it was, I want to say, back in July. So these were all really fairly new comps. For me, I like being conservative. If I'm looking to figure out what my value is, I want to look at comps that have sold within the last 6 months. If it's hard to find any comps that sold within the last 6 months, then I'm looking for comps that maybe from 7 to 10, and then from 10 to 12. You don't really ever want to go past 12 months. Some areas, maybe it's a little bit more rural and there's not as many listings and sales in that area, then you have to adjust. For me, a lot of appraisers, when they appraise a property, they go within a 2-mile distance. For me, I like being super conservative. So I would like to try to do with everything I possibly can within half a mile. If not half mile, then I'll go up to a little over a half a mile. But I like to stay for sure within a mile for a lot of different reasons. Again, it just kind of protects me. It allows me to know my numbers. The key to being successful, and I learned this when I first started out from my mentor, you win when you buy. meaning if you buy it at the right price, you're going to win. You have to know your numbers. You have to know what you're going to be able to sell it for. You have to know how much you're going to be able to rehab it for. You have to know just all the different oops factors that might come into place. Like really know your numbers, and that will determine what your offer should be. And if you offer at the right price and you get it, you're going to win. You win when you buy. And the same with lending. My mentor told me the stars may lie, but numbers never do. So know your numbers. So for me, I like to be super conservative when I'm evaluating deals. So I like looking again within a half-mile radius, within the last 6 months, or as close to the purchase date as possible. So if I see October is the month we're in now. If I see something that sold, in August or September, those are going to be my better comps than something that sold in January, because prices could fluctuate and change. But just using this screenshot as an example, you could see that prices started going up. Now our house is just a little bit bigger. And so this house was a very good comp for us at 124. These comps here were based off of similarities to our property, to our house. Where you can kind of get in the minutia is beds and baths, the difference between the beds and the baths, difference between the age, difference between the size, the lot size, and so forth. So there's a lot of variables that take place. I'm looking for properties that have very similar comps. So for example, in this property, we've got, tiled backsplash in our kitchens. We got butcher block countertops. We've got, tiled showers. We've got, LVP flooring throughout the house. We got new carpets in the bedrooms. And so we've got all these upgrades to take this house to the next level to get the top dollar. So when I'm looking at these comps, I'm looking for deals that have the similar upgrades or repairs that were added to the house, so that I know that I can compare. For example, if my house is a little bit bigger, then sometimes the price adjusts a little bit, but then I get added value for maybe having more bedrooms or maybe an extra bath or so forth. Based off our comps, we feel very confident that the ARV is 274, which if you remember, I had listed it the year before at 220 and it just kind of sat. Now, even if my number's off a little bit, let's just say that really it's still only 220, 230. I still had a very good win based off the way I bought this property. And I've had it cash flowing for the full year. So let's just say you're an investor that's wanting to lend me the $95,000 to purchase this property and the $45,000 or the $40,000 to rehab it. Well, you're going to get an interest payment every month, and you're going to be able to receive that cash flow, but you don't have to deal with the rehab. You don't have to deal with contractors. You don't have to deal with paying the taxes or the insurance. You don't have to deal with realtors and inspections and appraisers. You don't have to deal with any of that. It's very, very passive, and it's not as time consuming, and it's low risk. Very minimal time that you've got invested into this deal. Now, let's just say, 12 months comes up and I haven't sold the property yet. There's opportunities to reevaluate. There's ways to restructure deals. There's ways to get extra bonus points and origination points and extension points and so forth. And so there's variables and there's options that can be taken to keep your investment secure and to keep that cash flow coming in. I'm going to stop for just a minute and see if you have any questions concerning this. I'd love to answer any of those for you. Again, thank you so much for hopping on. We got a really good showing. Feel free to drop a question in the chat box or in the Q&A. Which software websites do you use for comps? I use REI Pro. I really, really like REI Pro a lot. You can get a subscription for $99 a month. One of the things with REI Pro is sometimes their beds and baths and square footage isn't always correct. So you do have to verify that, but they'll usually have a link for each comp that takes you to Google, and you can look up the Zillow or you can look up the Redfin and just confirm that the bedrooms, bathrooms, and square footage is correct. The other thing REI Pro doesn't do is they don't have pictures of the home. So you will need to click that link and try to see if there's pictures on Zillow or pictures on Redfin that will give you an understanding of the quality of rehab that was taking place in those homes. So again, we use REI Pro. There's multiples out there. Of course, MLS if you're a realtor. But again, you have to be a realtor in that area and you have to, be registered or whatever. So MLS isn't always effective for investors, especially investors like myself who do out of market investing. So we're located here in Fort Worth, Texas, but we do investing in Ohio, we do investing in Georgia, Tennessee, Indiana. And so for us, we have to find a software that will pull up comps in any part of the country. That's a great question. REI Pro. Keep the questions coming. Be glad to help any way we can. Okay, I'll go back to the slides here. So this is kind of how your loan's set up and how you can prepare for like your loan repayment. So there's secure terms, there's monthly interest payments, and then there's additional points at payoff. Those additional points we call origination points. A point is 1% of the loan. So for example, if you do $100,000 loan, you get 1 point, that's $1,000 for originating the loan. So right now, in the month of October, Freaky Fast is doing a promotion. We are doing a 10% interest payment plus one bonus for anyone who's got a capital at 25,000 to 99,000. If you have, say, 25 or 50 in the bank and you're wanting to deploy that, we'll pay 10% interest in 1 point. If you got 100,000 to 199, it's 12% and 2 points, and then 15% and 3 points for 200 and up. And these are our terms. Now, these are 12-month loans, and these are loans that are secured by the property, and the terms are in the notes. I want to break this down for you just so you kind of see the numbers. So let's just say you invested 50,000. At 10%, your monthly payment is $416.66. Your annual payment is $5,000 for the year, and then your point is $500. So you've made 11% on that 50 grand. Now, please tell me where in the market can you get that right now? That's super low risk. You can say, well, the stock market. Well, that was a few months ago. Again, people are losing right now. The markets are down. Maybe you've got specific investments that maybe you're doing yourself that are more active related that give you a higher return, but they're not passive income. So how are you investing? Are you doing it through a passive strategy or are you doing it through an active strategy? From a passive strategy, 11% is really, really good. Again, especially with a market that's a little shaky right now. If you invest 100,000 to 199, you'll get 12% a month. So this is what a $100,000 investment looks like. You get paid $1,000 a month, 12,000 for the year, and when the loan pays off, you get a $2,000 origination points added on top of that, which is giving you a 14% return. If you've got 200,000 and you want to invest, you get a $2,500 payment at 15% interest, which is going to give you $30,000 for the year, and 3 points, which is $6,000, giving you an 18% return. So these are the promotions that we are offering right now. These are great opportunities for investors to get into the game and get their money working for them. Start generating that cash flow and creating opportunities to invest. Right now, I've got deals that I am looking to raise capital for this week. You can schedule a time to talk with Alex today, and we can get you going within 24 hours and get your money deployed. Like I mentioned earlier, right now we're finding more deals than we are capital. And what's funny is people bring us the deals because they know that we're able to close and we're able to close quickly. And right now it's hard to keep up with the deal flow that we've got coming in. So if you got capital, the reason why we're making this promotion is because we need you, and I feel like you need us. Now, here's the thing. These things I just gave to you, it could be applied for anywhere. Maybe you have a friend who wants to get into the real estate game. Maybe you want to lend where you can have eyes on the property somewhere in your market. Well, these are great tools that I just gave to help you identify what a good deal is. Another thing to do when you are looking to invest with somebody is their track record. How many have they done? Is this their first one? Well, then it could get a little bit more risky. Is it their 30th? Well, they've got a little bit of experience. Or maybe they're a larger company like us and they've done 30 million. Then they've got a lot of experience. We've seen a lot of things. We've seen the good, the bad, the ugly. And through that time, we haven't always been perfect. We've made mistakes, but our investors have never lost. And if we've made a mistake, we've taken responsibility and made it right. And that's what you're looking for in a partnership with guys like us who are looking to borrow capital. Is it somebody that you can grow with? Is it somebody that you can build a relationship with and really have something long term? Like I said earlier in the conference, we're looking to get to 12, or in the next 12 months, we're looking to go from 30 million to 100 million. It's about 400 more properties that we need to purchase. So we're needing investors like you who are looking to get into the real estate game, whether if you're wanting to lend or you can do an equity play. You're saying, this sounds great, I like it, but I personally would rather have some equity. Because with private lending, all it is cash flow. It's just interest payments. There's no equity plays. There's no tax advantages. It's literally just guaranteed cash flow from the interest payments. And for some of you who may prefer to be an equity deal, we have that for you as well. You can find us at freakyfasthomebuyers.com, freakyfastinvestments.com, and meet and speak with one of our teams. We have what we call the asset fund right now. The asset fund is an opportunity to invest as little as 25 grand into 100 grand to invest. And these purchase the properties, and you own the properties, you have equity in the properties, and you receive cash flow based off the rental income or equity or appreciation that the property has. To invest in this, you do need to be an accredited investor. And that's the great thing about private lending, the two options. Private lending, you don't have to be an accredited investor. You just have to have some capital that you're looking to deploy. And it's a great way to get started to start building your wealth, build your investment portfolio up through real estate, and create that ability to become accredited. For investors who are accredited, you have two options. You can be a lender or you can be an owner from the equity fund. And so if you have any questions about that and you're more interested in that, there are some opportunities for you to get involved and start receiving immediate cash flow as well. And so that's something else that we'd be glad to talk with you about. Again, I'm Jason England, CEO and founder of Freaky Fast. And we've got a great team here in Fort Worth, Texas. And we're looking to grow, and we're looking to add opportunities for investors like yourself to come on board and be a part of that growth. I appreciate you hopping on. We've been on now for about 40 minutes, and we've had a great showing so far with attendees. So thank you so much for hopping on. I'm going to leave it open for just a few moments. If you have any questions or answers, please, or if you have any questions, please put them in the chat box or the question answer, and we'll be glad to answer those for you. Again, we have a special promotion this month for notes, private lending. And so if you've got capital and you want to take advantage of that, now is the time to do so. And again, we're offering 10% for investments between $25,000 and $99,000, and then 12% for $100,000 and $200,000, and 15% for anything over $200,000. Plus the different bonus point structure. Please let us know where you're watching from. Drop in the chat box, say, hey, I'm in New York, or I'm in California, or I'm in Mexico, or wherever you're at. Maybe you're on vacation sitting on the beach. see a couple of people have raised hands. Feel free to just ask those questions in the chat box, and we'll be glad to answer those for you. Again, thank you so much for reaching on. You can schedule an appointment with Alex at freakyfastinvestments.com. You can go on there and select a time to talk with him. You can reach out to him. Alex, if you don't mind, if you could put your email in the chat box as well. It's alex@freakyfasthomebuyers.com. alex@freakyfasthomebuyers.com. We'll just leave it open for just a couple more minutes and see if you have any questions. And if not, we'll sign off. Again, thank you so much for tuning in. I hope the information given to you has been very helpful and something that you've been able to take and start to apply in your investments in private lending. Looks like there's a couple more questions. Oh, chat is disabled. I'm watching from Wichita, Kansas. I'm so sorry about that, guys. Looks like it shows that it's open to everybody. Not for sure. Great question. How can you handle 400 additional properties? Who will do the construction for those? So we have construction teams in each market. A lot of those crews have multiple crews, subcontractors and so forth. What we're looking to do 400 in 12 months, that's about 30 houses a month. We're in 6 markets right now. We're in Indiana, Tennessee, Ohio, Georgia, and Kentucky. And so if you break it down, you're looking at 6-7 houses a month in each market. And that is definitely doable. So the idea is to kind of keep them on a rotation. So you're looking to have these done within 30, 60 days. And then once they're done, you've got them listed, whether to sell or whether to rent out. And then, so you're creating this pipeline and you're constantly building that pipeline up. So great question, but that is our goal. Now, if we don't hit it, maybe we only do 200 houses a month. That's still, or a year, excuse me. That's still a huge, huge accomplishment. So we are excited about that. And that's why we need investors like yourself. Great questions. Thank you so much for asking those. Leave it open for just a few more minutes. Again, I apologize. It says the chat is open. So if you weren't able to message in chat, I am sorry for that. Are you having these sessions weekly? Right now, it's bi-weekly. We're going to be hopping in and doing these weekly eventually at some point, but right now, bi-weekly. We were doing them on Thursdays. We are going to be moving them to Tuesdays, and feel like Tuesday's just a little bit better day for most. And so we do appreciate you taking some time out of your day to hop on and be a part of it. Any other questions? Definitely want to take our time and make sure we help any way we possibly can. All right. Well, we'll sign off. I'll give it just another 30 seconds, a minute. If you got a question, please feel free. And if you don't get it answered in time, just shoot Alex an email at alex@freakyfasthomebuyers.com. Again, thank you so much for hopping on. We really do appreciate it. We've got a few deals we're looking to close as early as this week. So if you've got some capital and you're looking to deploy it, we'd definitely love to chat with you. If you're looking maybe to get more involved in, say, a fund, an equity fund, please again reach out to us. We've got some great deals. Our fund the last 3 months has been averaging 10% annualized returns, and also creating great equity in the homes as well. So we've got a lot of great things working, a lot of great opportunities for investors like you. So please feel free to reach out and see how you can work with us and how we can start developing that relationship. You guys have a wonderful week. Thank you so much for everything. Talk to you later. Bye-bye.